Becoming an astronaut was one of the top career choices of my generation. Now it's been replaced by social media stars. Jean-Luc Picard has become Mr. Beast. But every time SpaceX launches one of those massive craft into the skies, we're all reminded that space is the final frontier. And it's one investors are traveling to at light speeds as they pump up publicly traded SPACs in hopes of finding the next SpaceX. So why not just invest in SpaceX? Well, because it's not that easy. So there are numerous ways you can invest in SpaceX stock. One is to become an employee. That's probably the most preferable one these days. You can also join a funding round as an institution or be a client of one of those institutions. You can buy shares on the secondary market. That's a topic we've covered before, but you're going to have to be an accredited investor. There's going to be lofty minimums and shares will likely trade at a premium. You can invest in a VC fund that holds SpaceX, but it's really tough for Joe Retail to find his way into a space fund as a limited partner, or LP as they're called. What anyone can do is invest in a fund that holds shares of SpaceX. That's what we'll focus on today. So one of our premium subscribers pointed us to this article by Forbes. It's how to buy SpaceX stock. And they talk about various ways that you can do that, certainly not listing them all, but they say here, they conclude, XOVR ETF emerges as by far the best overall option. Now I took a quick look at that ETF and I couldn't figure out how anyone with a background in finance could assume that when looking at the choices. And I realized that the gentleman who said that is the guy who created it. So you need to take what you find out there in the wild with a grain of salt and really learn how to analyze funds yourself. And that's what I'm going to teach you how to do today. So the first thing we want to look at is a valuation for SpaceX. Unfortunately, we have one as recent as December of 2024, $350 billion. This was based on a secondary sale where they were, along with some investors, buying back shares at a certain price. It's $185 a share. So notice we now have two reference points for valuation. One is market cap and one is the price of the shares. So when we think about valuing SpaceX, we can do some math on basic numbers. So they've been valued based on the last round. Now from here we can have an up round where they become valued more. We can have a down round where they're ascribed a lesser value, or we can have an exit and there'll be a valuation associated with that. But without revenues, we really don't know anything about valuation. And even with revenues, we don't know about prospective profitability. So we expect all disruptive growth companies to not be profitable because they're in the process of scaling, but we look to gross margins to tell us about the potential of profitability down the road. Now, Bloomberg came to the rescue with this piece here that talks about how SpaceX should bring in about $15 billion in 2024. So we're assuming that may have happened last year. And if we use that assumption of revenues along with their valuation of $350 billion, we can calculate what we call simple valuation ratio. It's really price to sales. Take the market cap of the company, divide that by annualized revenues, which would be last quarter revenues times 4. Since we don't have that, we'll use the $15 billion number. We get a simple valuation ratio, or SVR, of 23. To put that into perspective, our catalog average is 6, and we don't invest at 3 times our catalog average, so let's say 18. This is pretty richly priced at these levels. We don't know what margins look like, but does it really matter? Because we find out in that same Bloomberg piece that SpaceX is expected to realize $3 billion in operating profits in 2023. They said that themselves, so you can assume they hit somewhere near that. Who knows what they brought in during 2024, but it would seem like they had operating profits then as well, particularly because Starlink may be having an impact on their margins. We would assume that subscription service has higher margins, and sales for Starlink were set to outpace and exceed the launch business last year in 2024, according to Bloomberg. So then they'd be at least $7.6 billion, right? Now, Quilty Space estimated $11.8 billion in Starlink revenues for this year, and there's a breakdown here of where those come from. But Musk has said before there's going to be a cap on how much money the launch business can make, but Starlink could eventually reach revenues of $30 billion a year, perhaps more. We did this piece. This is a video piece on Starlink's being a $1 trillion opportunity. There's also a linked article there, which we wrote quite a while back, which proposes the same thing. Now, Starlink achieved cash flow break even in late 2023, so we're assuming that that business there is going good. Now, looking forward, let's say this $350 billion company with $15 billion in revenues does the classic 10-bagger move, and it becomes a $3.5 trillion company with $150 billion in revenue. So first of all, there's no easy 10-bagger from here or ever. You could have Musk going mental or getting hit by a bus. You could have solar flares fry a bunch of equipment. Stuff can get blown up. Space junk can get out of hand. There's a lot of things that can go wrong in this very risky domain. But let's assume everything goes as planned. SpaceX grows 30% every year for a decade, which is what it would need to do to become a $3.5 trillion company. How does a fund's exposure to SpaceX change over time? So let's look at the ARK Venture Fund, which now holds close to 16% in SpaceX. So assuming a 16% weighting, what does this look like after a 10-bagger? Well, we first need to consider the 2.9% fees ARK's charging every year. We need to consider, more importantly, what the other 84% of the portfolio looks like. But let's forget about fees for a second and just focus on what weightings look like. So we're going to assume that 84% part grows at 9%, what the stock market grows at a year. And then we'll assume that SpaceX grows 30% a year for a decade. At the end of that decade, the fund would hold a 47% position in SpaceX, so still not even a majority. Now, these are nice paper gains, but when does a fund, or when should a fund, realize a profit? Now, a traditional VC is going to look to capture on exit. So you ask, well, would SpaceX have had an IPO by the time they hit a $3.5 trillion market cap? Will it ever have an IPO? We don't know the answers. But the question here is, what does a fund do with that profit once it does realize an exit on it? Well, ARK would likely reinvest that money, hoping to find the next great growth story. So what if they're not able to do that and all those gains from SpaceX then become eroded? You see, this isn't as simple as investing in a fund that has SpaceX and making a ton of money. So when you evaluate SpaceX funds, always look at what exposure you're getting for that investment in SpaceX, because remember, this is about investing in SpaceX. At what valuation were those shares purchased by the fund? How much alpha has the fund manager managed to capture? That's interesting. It speaks towards their competency levels. It also matters for funds purchasing SpaceX today at premium prices, then being able to wave it and say, look, we're holding SpaceX. What is the company's policy for allocating profits off of their investments? Are they going to plow that back into green shoots? And what if they fail at doing so? How comfortable are you with their overall strategies? Probably more important, because that's where the most of your exposure is coming from. So even after a 10-bagger, and we happen to like Baillie Gifford's funds quite a bit and their accompanying philosophy, but don't just invest in them because of SpaceX. And that's the conclusion we reached in this piece we wrote 4 years ago, investing in SpaceX with the Baillie Gifford U.S. Growth Trust. You see here, it's around 7.6% SpaceX is of the fund. Now, what you need to do is understand the mechanics of any fund you're invested in. And the annual or semi-annual reports really contain the meat and potatoes. So you can see how the net asset value changes over time here for this particular fund. 34% of the holdings are private, so the rest are public. So really you're paying, 70 basis points for only 34% exposure to private companies. And you could argue that's reasonable when you look at ARK's 2.9% fees. But it's all about, for us, exposure to a particular asset class. And when you dig through these financials, you'll then come across SpaceX, and you see three fields here of interest: book costs. So now we know what they purchased shares at. Market value as of 2024, mid-2024, you see there 51 million pounds roughly. And the market value at the end of 2023, 39 million pounds. But is this enough exposure, this 7.6%, because now we can do the math on that value of SpaceX against the NAV, is that enough to justify investing in that fund? We wouldn't think so. But you always need to be thinking about things in terms of exposure. So perhaps this Scottish Mortgage Investment Trust, which I loved the accompanying paper from their principals on how they manage this fund. You're paying 35 basis points, really a bargain for active management of this sort, but not liking all the publicly traded company exposure. Again, you have SpaceX here at 5.1%. So at a 10-bagger uplift, it would move to a 20% weighting, all things being equal. So not enough exposure here in SpaceX to justify investing in this just because of SpaceX. Brings us to a company raised by our premium subscribers, the Edinburgh Worldwide Investment Trust, EWI. Notice here how they're tracking the value of the fund against the NAV. That's important for reasons we're going to talk about shortly. The ongoing charge, they're 70 basis points. What you'll often need to do is aggregate the exposure. Here you can see they list SpaceX twice. It's listed as Space Exploration Technologies in these various funds. So you can then look at this interim report from last year and see that 11% of assets come from SpaceX. But when it comes to the exposure to startups in the entire fund, that's around 28%. So again, we don't like these private company funds that have a heavy exposure in publicly traded companies. What's the point? When you have exposure that falls under 1%, it's really too minimal to even take into account. And the example here, Fidelity's Blue Chip Growth Fund, you see at 0.48%. That's too little exposure really to invest in the fund only because of that. Another fund out there, Barron Partners Fund, 2.24% fees for 40% Tesla exposure. So you're getting 10% SpaceX. Well, that just doesn't make sense at all. Just if you want that much exposure to Tesla, then just hold Tesla. Don't pay this gentleman 2.24% to do that. Then you have the XOVR ETF, the one mentioned at the beginning of this presentation. They switched their strategy up and verbalized that about how they're now utilizing this proprietary ER30 total return index, which is made up of 30 U.S. large cap entrepreneurial stocks. So they have their own proprietary methodology. Essentially, they're doing active management with an index. It has a high turnover. You get right now 9% in SpaceX, and the rest of it is in these publicly traded stocks that they've selected in there. So this just isn't an appealing ETF at all. The 75 basis points you're paying for 9% exposure to SpaceX. Now, when it comes to all SpaceX funds out there, they're going to have a breakdown of what they contain. SpaceX holdings will, they should certainly have a cost basis and current price that they're marked to market with. The value of a fund is the net asset value, and nearly all pure exposure VC funds out there trade at a discount to NAV. We've looked at that in the past. Any fund where the price of the fund has become completely disconnected to NAV should be avoided like the plague. And this NAV versus value method, it works for both closed and open funds. But one hyped up closed fund that should be avoided like the plague is this DXYZ. It's now trading at over 12 times net asset value. This is going to end horribly. We warned before about that. You see the spike in this chart on the left. We warned there. It settled back down to values that still didn't approach NAV, and now it's being pumped again by a bunch of FinTwats. So Destiny Tech 100, the company that offers this vehicle, you look at one problem here, the cost of their investments. It's a fund, right? They spent $83 million on investments, and now they have $56 million to show for it. So you may want to go take a look and see what happened there. But when it comes to their net assets, you can then divide those out by the number of shares, and it's $5.15 a share. So what it's trading at now is ridiculous. Of course, the cheerleaders out there will say, well, SpaceX is now up. All right, fine. So SpaceX is 40% of the net asset value of this fund, which is part of the attraction there for people that don't understand how funds work. Even if the value of SpaceX doubled, let's say it did, you'd still have net asset value at around $7.22 a share. So what you want to do here is pay attention to future NAV declarations. Don't try to play musical chairs with this thing. And if you don't understand what's going on, Acadian Asset Management put out this piece. It's really good. They talk about, I think I'll just read this one sentence. They said, the stock is a compelling story that appeals to the type of retail investor who is unaware that closed-end funds have a NAV. And the people coming around commenting on our commentary on this will demonstrate just how some individuals out there just don't want to learn the most basic information that helps them navigate pitfalls like this one. This article explains why something gets this bad. So funds that hold SpaceX, we've talked about, they're all listed down here. You can see the percentage of exposure you're getting for each along with what you're paying for that exposure. And of course, the honorable mention here would be Alphabet or Google. This becomes somewhat difficult to try to figure out how big their investment is. It's certainly not going to move the needle much, that's for sure. So you can look at assets here on their balance sheet and see this entry here, non-marketable securities, and then you can go down to another section of their filing, and then you can note the Non-marketable equity securities, initial cost and carrying value. It's interesting to look at the footnote there. That represents $22.4 billion in gains and $8.5 billion in losses. So again, like a fund, Google invests in startups, some they win, some they lose, and that all needs to be taken into account when you're talking about a fund that's holding one very popular startup that's quite richly valued. So they have $13.9 billion in gains on whatever these securities represent. One would assume a lot of this value here represents their SpaceX investment. We don't know. But the SpaceX exposure we do know that you're getting from this $2.4 trillion company is really minimal. So our take is this: SpaceX will likely debut above our ideal market cap range. Now, we could probably overlook that because they're an undisputed leader in space, and this is where we'd like exposure. But we can't overlook stocks that suffer from extremely high valuations. Prior to an IPO, you're not getting publicly traded company exposure, you're getting startup exposure, and we'd ideally like the entire fund we're invested in to have startup exposure as a whole, not publicly traded companies. We have enough of those. So a fund with at least 90% exposure to startups is quite appealing. ARK's fund is interesting given their AI exposure, which I think something like the top 5 AI companies out there by funding ARK's holding in that fund. That's interesting. We'd want to see that 2.9% fee they charge fixed. No, well, the discount expires and we're now charging 4.71% stuff. We need to see that fixed. I think that when you start to get into the 4.71% per year charges, that's just too steep. Funds seem to have realized that adding SpaceX shares attracts attention. So I think you should really take the time to analyze heavily any fund that has SpaceX shares that you're thinking about investing in. Accredited investors with sufficient wealth can go to secondaries. But don't invest in any fund vehicle unless you like their bigger picture, because that's really what you're investing in. Upwards of 10% allocation in SpaceX seems meaningful in this context. Pay attention to the biggest predictor of performance when it comes to funds, that's fees. Don't pay premiums to NAV because of a bunch of morons out there. Don't try and play musical chairs with momentum stocks, because over the long term, there's a 95% chance that you're going to underperform at least. And if we missed a fund here, please drop it in the comments section. I'm going to go ahead and leave you with a video that explains just how compelling Starlink's $1 trillion opportunity is and why we would find SpaceX to be so attractive over, let's say, a space SPAC like Rocket Lab. Give this a watch. Thanks so much for taking the time to watch this today.